inflation is slowing down, and it's slowing down pretty rapidly recently. It's down by about 2/3, and that's the Consumer Price Index, which is the most commonly known index. So it fell from 9% to about 3%. And all the key drivers that drove it up are easing now. So that's goods inflation. Goods prices got very high in the pandemic, and the inflation rate is now about 0, and it's tipping over into deflation. Service inflation is also falling. And the largest single component of that is about 30% of the whole inflation index is what they call shelter. So that's rent of an apartment, rent of your home, and kind of the estimated cost of what it would cost you to rent your own home is high, but it's falling. And especially if you look at alternative measures like apartment lists that track it, rents are decelerating pretty quickly right now. And then you have snarled supply chains, and they're starting to normalize. And there's one index that the Fed started up recently that shows the pressures are the lowest in 25 years now. And then wage growth was a key issue too, and that's starting to slow. It's been a big concern for the Federal Reserve. Shortages are easing as more people are coming back into the workforce. There are fewer job openings in the data, and productivity is up, but there's still sticky elements. And inflation is above the Fed's 2% target, but the trend is really encouraging. And the thing about lower inflation is that enables the Fed to pause and to eventually cut. And we expect the trend of lower inflation to continue into next year. It's not a straight line, but steadily.